You are now listening to the Going North podcast with your host, author and speaker, Dom Brightman. And every Monday and Thursday, you're going to hear the voice of a different author share their stories, expertise, and their struggles that they had to overcome in life to leave you inspired to get more out of your life. Be sure to not only listen to this episode, but share with others, connect with the authors, and always advance others to advance yourself. Now let's get on with the show. And today on the Going North podcast, we're back at you again with another author, baby, but not just any author. This podcast is known for attracting all sorts of wonderful people from all over the world who have made great strides in life and don't like to stop at where they are and keep on going. And you're probably wondering why, because this wonderful guest right here last year was able to buy over $45 million worth of commercial property. In the year of 2018, he is a full-time real estate investor and the founder of Cash Flow Connections, so CFC. And no, that's not CrossFit Catonsville for the Baltimore listeners, but Cash Flow Connections, baby. And since he started that company, he has helped investors allocate capital to over 100 properties, which have a combined asset value of over $350 million. And that has helped him because he has experience in so many areas like self-storage facilities, residential, mortgage notes, mobile home parks, single-family residential acquisitions, hard money loans, and tons more. And you're probably wondering who this wonderful person is. It is the one, the only Hunter Thompson. How are you today, sir?
Hey, thanks again for having me on. Much appreciated.
Yeah, yes, sir, indeed. Yes, sir, indeed. Glad to have you on, man. It's all about folks who are advancing others, and you are doing that, man. So mind filling in the gaps I may have missed during the introduction? Tell us a bit about yourself.
Yeah, sure. So basically, I was one of those kids that when I was very young, figured out supply-demand disequilibrium. We lived next to a really popular concert venue. And as soon as I realized that I could, I was selling parking spaces to my parents' place for like $5 or $10 a piece. And that, just being able to sell something like that and make, $50 or maybe even $100, depending on how small the cars were and how many we could fit in, I thought that was like the most empowering thing ever. And so since that early stage, I've been an entrepreneur and had a business in high school and then college, and then played online poker during the poker boom, which is something that was really remarkable. We can talk about if you want. And then right around that is when the real estate collapse happened. 2008 happened. And I did not have a lot of exposure to financial assets back then, but I knew that because of how decimated and how serious the collapse really took place was, there was going to be an opportunity in financial markets. So it wasn't really clear as far as where I wanted to go. I started investing in stocks and had some success, like most people did that started investing in 2008. But in 2010, something happened that a lot of people don't talk about, but for me, it was a really monumental moment, and that was the European debt crisis. So it was very similar to the United States crash in 2008. A lot of the banks froze up. They had complete lack of liquidity. You couldn't buy and sell anything, and many people had problems even getting into their bank account in some countries. And so I remember it was causing unbelievable volatility in the U.S. markets. And I live in Los Angeles, and so I was waking up to pay attention to the market on market time. And at the time, at least, I wasn't a morning person at all, so this was a major chore. But I remember watching, the pundits on CNBC, and they were talking about the Greece bond yields. And this is what everyone was paying attention to. They were saying if the Greece bond yields stayed below 7% for the 10-year, that the S&P 500 was going to be fine, and that everything was going to be fine for the day. But if they closed above 7%, the S&P 500 was going to collapse. And this was happening on a daily basis, where the S&P 500 was going to go, the Dow Jones going through 600-point intraday swings and just complete volatility. And this was my last straw moment. This is my complete wake-up call, because as a single person or even as a small family office, how would I be able to predict that the Greece bond yields would be playing such a significant role in my financial well-being? And if I was able to predict it, how could I mitigate that risk? It became clear that all of this talk of, quote, diversification was really just a sales tactic and just marketing. I mean, it's all so connected. All these risks are incredibly complicated. And so that's when I realized I needed to focus on something that was simple, that a small family office or an individual could actually mitigate those challenges. And that's what eventually led me to real estate.
Oh, man, real indeed, real indeed. That's awesome, dude. I mean, started off at a young age, man, selling tickets to party from your parents' house, man. It's like, man, garages do it. Like, why can't I do it?
Yeah, exactly.
Yeah, man, that was like, what, 12 or 13?
Oh, back then?
Yeah.
Oh, yeah. I mean, I was about 5 years old back then. In fact, we even had my sister out there who was 3 years younger than me, so who could barely walk. But she was probably the marketing strategy out there, try to attract people with a little girl walking around, and that was it. And, of course, I had to split the proceeds with my mom. So it was like I understood the benefit of owning real estate at a very young age as well. She didn't have to do a lot of work. Now, her yard might have gotten messed up because the cars that were parked on there. But at the end of the day, she was generating that passive income while I was out there hustling. So I understood that as well.
Yeah, Mom's like, yes, that's my son. That's right, bringing me the money. Bring me all the money. Probably petting the cat with an evil mustache.
Right. Mr. Scrooge over there.
That's right, dude. But that's really awesome, dude, and it's really interesting indeed. Like, of course, it shows that the testament of how some folks can really take a negative moment and turn it into a positive moment, because I think it was I think a great way to talk about how recessions are a good thing for some people, because that's usually when a lot of folks become wealthy, and of course you had that time where you were just investing, and in 2008 the crash happened, then you're able to turn that around to actually get into real estate and come out even better than before.
Yeah, and it's one of those things where, that was really a defining moment for a lot of people in their career, whether they were able to succeed or not. And so I was very fortunate in the fact that if I was just involved in real estate 3 years prior to that, it's very likely that, unfortunately, you and I wouldn't be having this conversation right now, because I'd be trying to clean up the mess that I was in financially. And so I know a lot of people that even had really great track records but struggled significantly, because that was quite a rare situation. But because that was the situation I was born into, my entire investment strategy is really focused on avoiding those types of volatilities and those types of challenges. And so, we can get into some of the details, but generally speaking, real estate, for the most part, always does well when the economy's booming and the capital markets are loose. And so if you can identify types of real estate that are recession resistant or have the ability to weather that storm, then you have the best of both worlds. And I'll give you a perfect example of this. The mobile home park business is probably the easiest example of this, because the worse the economy does, the more demand there is for affordable housing. Now, that doesn't paint the entire picture. That doesn't mean that every mobile home park investment is going to be a success. But generally speaking, the demand being stable counterbalances the other challenges that may be going on in the economy. So if you may have a problem getting a loan for a property or something like that, that is counterbalanced by the fact that demand is extremely stable, if not increasing during those economic corrections. That's one example. Another one is self-storage. And that one is not as obvious, but I think it's just as compelling. People use that product when they're going through some kind of lifestyle change or life transition. And so you see people using the product when they're moving or downsizing, or they have kids move home from college unexpectedly. All of this stuff is more common during recessions, and those are really the driving factors for why people use self-storage. And so that's really how we try to build a portfolio, with the foundation of recession resistance. And then if you want to, you can have some exposure to other asset classes, even stocks, bonds, and mutual funds. But I think building an entire portfolio, you have to look at some of those assets that are going to perform well in all stages of the economic cycle.
Very powerful indeed. And that's really big thing that really caught my eye about you was the self-storage as an investment vehicle. So mind going deeper into that?
Yeah, sure. So generally speaking, investing in real estate, when most people think of investing in real estate, they think of investing in single-family houses. And there's good reason for this. Generally speaking, it's because there's a relatively low barrier to entry. Most people have lived in a single-family house. In most parts of the country, if you have $30 or $50 or maybe even $100,000, you can buy a pretty nice property. You can rent the property out. If the property's rented, you're making cash flow. If it's not, you need to get it rented. But the simplicity of the asset class is really why people like it. From my perspective, though, that simplicity doesn't allow you to produce what I refer to as asymmetric returns or favorable risk-adjusted returns. And the way you get those is where you get into asset classes that are much more complicated. And those complexities lend itself for there to be a very big discrepancy between a mom-and-pop owner that only owns one or two or maybe even 3 properties and an absolute best-in-class owner that may own 50 properties, because you start to get systems in place to account for those complexities. So I'll give you an example that I've used many times before, but I think it paints the picture very clearly. So when you invest in self-storage, we can buy properties based on in-place income, usually from mom-and-pop owners, because the vast majority of the business is owned by independent owners. A lot of them only own one property, let's say. We buy that property. The next day, we contact our contact at U-Haul, and they park 15 to 50 trucks on our facility. Then we rent out those trucks to the tenants as they're moving in and out, and we get a commission for facilitating that transaction. Mm-hmm. That strategy is something that's not quite available for something like a single-family house, because it's running more much like a business rather than just a real estate investment. And there's many, many line items that I can go through, but that one strategy right there, that could result in us getting an extra $50,000 in income net to the bottom line on an annual basis. And so real estate trades on a multiple of income. So you may be talking about $600,000, $700,000 of value that you just added by just implementing that strategy. So the reason I find that compelling is because looking at things on a risk-adjusted basis, keep in mind, we don't own the trucks. We don't maintain the trucks. We don't even have any control over those trucks. We just simply call our contact and allow them to do that. And so that's one of those examples where the complexities really do that. You can do insurance or, raising rents more effectively. The business operates on 30-day leases, so you can raise rents very quickly. Also, it's a relatively inexpensive place to store things in terms of the gross dollars, maybe $100 a month, $150 a month. So if you raise rents by, let's say, 6%, it may be only $9 a month. So the question really is this person going to take the time to take the day off work and hire movers, get a rental truck, move down the street, where they're probably going to do the same thing just for that $9 a month? And historically, we've seen the answer is no. And I can go on, but generally speaking, all those different ways to add value, they really start to add up. And so if you can add a lot of value without taking on proportional risk, your investors are going to be happy.
Beautiful indeed, beautiful indeed. That's really innovative. It's got to be amazing. And what led to just that discovery, man? It's just the self-storage. Because that's something that folks really don't see and don't think about.
Well, I think that when I'm looking at potential investment vehicles, I really am focusing almost exclusively on the bottom line. And that's not always everyone else's strategy. Now, there's some people that really want to own a property that they're really proud of. They want to drive by the property and say, look at this incredible shopping center. I own a piece of that. And they want to be able to drive to the property. They want to be able to touch the property. They want to be able to brag to their friends about the mall that they own or the hotel that they're able to stay at a discounted rate because they own part of it. That's not me. What I'm looking for is cold, hard cash flow and reliable and predictable. And the way to accomplish that is sometimes looking at asset classes that aren't as sexy. And so I mentioned the mobile home park business, for example. No one is ever bragging to their friends about their friend that they know that owns a mobile home park. But probably several listeners of the show have some random uncle that made a lot of money in mobile home parks. And so those are the types of things that I'm more interested in. And the self-storage business is a great example of that. I mean, it's a massive, massive asset class that doesn't get nearly the attention it deserves in the investment community. There's actually more self-storage facilities than there are McDonald's, Subways combined. And there's actually one more in there. There's 55,000 of them, which is more than all of those combined. McDonald's, Subways, yeah, and one other company I can't remember right now. But the point is, how many Subways alone have you seen? Well, there's more self-storage facilities than all those. It's a massive business that is always looking for investors. And one of the reasons it doesn't get the attention it deserves is because the ultra-large private equity companies, they typically aren't interested in purchase prices of less than $20 million. And so self-storage facilities aren't typically that large or that valuable. So those large groups don't have the time to focus on those really small purchases, and it allows an opportunity for investors such as myself and companies like mine to take advantage of that.
That is awesome, indeed. And you are right about the self-storage units. I see them at least every time I go out, whether it be work or some other place. You see all these self-storage units, and then they're building new ones, or they're just turning an old area to a self-storage space. So it's true. They are out there, and folks got tons load of stuff and probably borderline crap in their house or their apartment that just need to stow away. So that's really true, and it's kind of interesting. It's kind of like those hiding in plain sight kind of things that you really need to think about and probably just need to look for.
Yeah, and you know what? I actually just remembered, and I started to say this because it was actually, I was like, there's no way that's true, but it is true. It's Subway, McDonald's, and Starbucks. All of those combined in the United States. So that's how large this is considered. So you say, how many times have you seen a Subway or McDonald's? I mean, Starbucks is literally, that's the whole thing. It's on every single corner. So just imagine that all across America, that's the case. It's a pretty interesting thing. And the fact that they're so frequently owned by mom and pop owners that aren't taking advantage of all these ways to add value really lends itself to a unique investment opportunity.
Wow, so Starbucks too?
Yep, that's right. All of them combined.
Huh. I guess caffeine lost that battle.
Yep.
Oh, man. Well, that's freaking awesome indeed. So since it looks like you pay attention a lot to the self-storage units, do you see any specific trends taking place in that area and how they may affect folks who may be investing or just starting to invest?
It's an interesting time that to be investing in self-storage in particular, because the business typically goes in these fluxes of development and then non-development. So in the early 2000s, self-storage was all the rage. It was a massive dump of square footage that took place all over the country. And then when the economic correction took place, the Great Recession of 2008, all that development basically stopped. And so for about 10 years, basically development has been not non-existent, but relatively speaking, basically non-existent. As the occupancy rates have increased, it became more and more financially viable to develop new self-storage facilities. So now we're starting to see that development come back with a vengeance. And so people are concerned about, is self-storage being overdeveloped? Well, you have to be really cautious about that metric in self-storage because they're relatively easy to build. They're a simple vehicle. They're a simple structure, which has a lot of advantages. But generally speaking, people know that you can develop them usually cheaper than you can buy them. So if your listeners, some of them are probably familiar with commercial real estate, there's a metric that's commonly used in the multifamily business, for example, which is the replacement cost. And if that replacement cost is below your property in multifamily, it usually means it's probably not a good idea to buy that multifamily property because someone can build one for cheaper right next door and it'll be a newer property. Well, in self-storage, it's usually cheaper to build them than it is to buy them. So there's a lot of ways that you need to make sure that the market you're buying in is favorable in terms of the supply and demand equilibrium. And one of the ways we do that is there's a couple of rule of thumbs. First of all, the average across the United States, there's about 7.7 square feet of self-storage per person in the United States. And so what we want to do is identify markets where the number of square footage is less than that, so that you can look at like a supply-demand equilibrium, so that even if, we can take a 5-mile radius, for example, and say this is how many people there are per square foot. Now, if that number is below 7.7, that means that there's a market is undersupplied, and we can actually estimate how many square feet that market is undersupplied by. So if the market is undersupplied by 300,000 square feet, that would mean that you could develop 3 100,000 square foot facilities, which are be very large facilities, all within that same 5-mile radius, and you'd probably still be in a really good position. Now, there are some exceptions to that rule. There's some markets that have 12 square foot per person, for example, that are still where all the properties are really high occupied. But generally speaking, that's a really good rule of thumb. You have to be cautious about that because they are really easy to build. Now, you do see those discrepancies in markets like Florida, which is one of the reasons I'm a huge proponent of investing in self-storage in Florida. You have a combination of a lot of factors working together. You have the baby boomer population there. Many of them are downsizing, and a lot of them are using self-storage. You also have the state is physically surrounded by water, and so there's a physical moat prohibiting development in certain directions, which is a very good sign if you're worried about development. But then also you've got really affluent markets, because you've got these baby retirees, many of them water-facing property. And when you have that, you got water toys, you got boats, you got jet skis and things like that, and those need to be stored. So cumulatively, I think Florida makes for a great market. The economy's obviously been booming there for quite some time, and I don't see that changing anytime soon as more people are looking for states that have favorable taxation. Florida doesn't have an income tax, for example. So that'll kind of give you an idea of some of the current market updates of the self-storage business. It's a fascinating vehicle, and so anytime this development comes and goes, people always get concerned. But there was a time in which, from about 1990 to 2000, the asset class basically doubled in size. It went from 20,000 facilities to 40,000 facilities. And during that time period, you saw occupancies still remain relatively high, and net operating income continued to grow. So this is nothing new. The vehicle itself is still strong, similar to the fact that real estate is a great vehicle. It's always a great vehicle, regardless of market timing, etc.
Oh, yeah, the vehicle that everyone loves to drive. So for those who are getting or looking to get started in real estate, they may want to know some of the pitfalls and traps to avoid. So what is possibly one of those early mistakes you may have made that you want others to try to avoid when they get started investing?
Well, I'd say that when you're getting started investing in real estate, one of the first things you have to ask yourself is whether or not you want to be passive or active. And the way that I define that is, if you're an active investor, you're the one that's physically owning the property. You may even hire a third-party property management company, but you are the one that's interfacing with that third-party property management company. And what my company does is help people make passive investments. So these are investments where they're basically limited partners. All they do is put up the capital. They don't have interactions with the managers. They don't have conference calls and things like that. They get a quarterly report. And so it's a very passive investment. And so that is not for everyone. For some people, all they want is to see that cash flow coming in. For other people, like I said, they want to touch the asset. They want to have the control to buy and sell the asset when they want to, etc. For me, I'm willing to give up that control for diversification. Now, in terms of the mistakes that I've made, one of the reasons that I started the company is that I had a really bad experience investing in single-family houses. And the reason for this is because when you're investing, let's say $30,000 or $40,000 a year, or $30,000, $40,000 or so, you're investing with the property management company that's probably going to make $50 or maybe $100 per month managing your property. The challenge with that is that that's not a lot to gain or lose. And so you're not dealing with people that are as sophisticated. They don't have as much, you don't have as much leverage over them because of the fact that, the difference between $50 or $100,000, $50 or $100 isn't really that significant. And so, you're really out there in terms of people commit fraud all the time in that business. Now, if you commit fraud in the world of commercial real estate, there are some really serious problems you're going to have, legally speaking. I mean, criminal components can happen very quickly because people are pooling together. You're entering the world of securities, and you just don't want to be messing with all that. And so we use that to our advantage. So, I lost almost $30,000. Well, I shouldn't say that. I guess technically it was about break even, but I lost $30,000 of my time flying back and forth to a property trying to fix the problems. And I want to help people avoid that. And so the way to do that, in my opinion, is to invest passively with teams that are absolute experts in their field, that have $100 million of management or more. And I think that that's kind of the way that I would go about getting started, is making sure that either your passive approach or active approach aligns completely with your gut instincts.
Oh, yeah. Man, so $30,000 in time in flights?
Yeah, I mean, I'd say that, I said, the financially is basically even, but my time is valuable, and I certainly lost $30,000 of income that I could have generated if I spent my time otherwise. You're just trying to chase, and when you really should just cut bait. But when you're getting photos of broken things and things that have been stolen, and you feel like you're getting inflated on all the prices that you're paying to make things right, it's challenging, especially if you're inexperienced, which I was at the time. This is some of the first deals that I did, and unfortunately, that's how most people get started in real estate, is investing in those single-family houses that are managed by a manager that might not have their best interest at heart. So, that's my word of caution for people that are considering going that route.
Oh, man. I bet you probably read a lot of books in between with those flights back and forth to the property.
Yeah, I did. I read a lot, and I also could have written one on that experience alone. But, definitely learned a lot, and was very quickly introduced to the world of commercial, thankfully.
Oh, man. Well, glad you're still alive to tell the tale about that one. Oh, my goodness.
Same.
That's right. Made it through TSA, baby. Multiple times. That's right.
Right.
Well, beautiful indeed. Beautiful indeed. Well, of course, I'd like to ask every guest is if they were to go back in time and they were 25 in the current year of 2019, what advice would you give to yourself?
Well, I'll skip the quote, buy Bitcoin and stuff like that just for the listeners, because I'm sure they've heard those a million times. But, something that I found later that I wish I had found earlier is a combination of blocking out significant amounts of time and focusing on things that are going to help you take your business to the next level. That's really all that matters in business, is making those big monumental steps. And if you're not focusing a lot of your energy on those steps, you're not going to be able to accomplish that. So what I mean by that is those steps are almost never answering the phone, answering emails, doing ticky-tack things that don't help you scale. And so most people get caught up acting reactionary like that, thinking that that's going to be the way that they get to the next level. I can promise you that the difference between you and Warren Buffett is not his ability to answer emails quickly. The difference between all of us and Warren Buffett is really the result of him being alone and thinking for an hour and a half to 3 hours on big picture things. And so I try to block, usually work from 7:30 to 10 without answering emails at all, and I don't have any distractions at that time. And whatever the thing that I think is going to take my business to the next level, that's usually my focus. For me, once it gets to 3 hours, I start to lose focus. But that would be the thing that I would tell myself early on. Make a decision as far as what you think that big thing that you need to focus on is on a quarterly, weekly, or annual basis, and focus exclusively on that for extended periods of time. And this is something that's covered in 2 books. One is Deep Work. The other is The One Thing by Gary Keller. I think that both of them are great books, and so if you're interested in more on the topic, check those out.
2 great books indeed. 2 great books indeed. And solid advice too. I mean, that deep focus is really a powerful thing when you make the time for it.
Yep, absolutely. And again, like I said, there's just so many people that are focusing on reactionary stuff. And I'm not saying this to brag, but I pretty much do not answer my phone ever. I just don't. The risk of what it may cost me in terms of whatever I'm working on is far outweighed by, what I could potentially gain. So I will always call people back, yes, within 24 hours, but I just, having a phone call come in is almost never a great sign. It's always something reactionary. You can always call them back on your terms when you're in your state of mind. But yeah, that's something that I just don't like to be in a reactionary state of mind, especially in the first half of the day.
That is so true indeed. That is so true indeed. Reactionary mode, full loser brain, freaking losing your mind, running around like a headless chicken. Like, nope.
Exactly.
Not doing that. Not doing that. Woo! Well, alrighty. For those who want to keep in touch with you and possibly even one day build up their financial six-pack to invest with you, what's the best way to get in touch with you? We know phone call ain't the best method right now, so what's the best way?
Thank you for saying that, and I just want to make that clear up front. Don't worry about calling me; it's nothing personal. So yeah, I mean, if you want to learn more, you can check out our website, Cashflow Connections. We also have a podcast which is on the iTunes store. So if you like podcasts, obviously, such as this one, which obviously, thanks again for having me on. It's been a pleasure, and I know you've added a lot of help to your listener base. You can find us at Cashflow Connections Real Estate Podcast, and I have an ebook about self-storage that I'm happy to give away to anyone that shoots me an email at info@cashflowconnections.com. I'll send you a bunch of goodies and some ebooks as well.
That's right. Hunter's got a great podcast. He even featured one of our past guests, Damian Lupo, who is like a walking guru of knowledge. I want to check that episode out too. Alrighty. Yep. So any parting words for the folks still listening?
Hey, I just want to say thanks again for making it through this episode. And again, thanks for having me on. I'm always happy to correspond with new investors and help out in any way I can.
Thanks a bunch for your listening ears on the Going North podcast. I hope you really, really enjoyed that episode. If you enjoyed the episode, be sure to share it with your friends and family, especially those who love podcasts and love listening to some inspiration and motivation.